In the last few hours, the market did something it's not supposed to do in a healthy system. Roughly $600 billion got erased, fast, like someone pulled the plug. And then the same market turned around and jammed even more money back in, within the same session, like nothing happened. That isn't confidence. That is stress. And right in the middle of that whipsaw, silver volatility detonated to 115, while the paper price was being shoved around as if the shortage story died overnight. It didn't. Something broke. And the tape is telling you what it is. I'm your host, no fluff, just the mechanics, the data, and the playbook. Here's the headline nobody is connecting. The violent equity whip, the sudden repo window draw, and the metals dump happened together because this wasn't a story-driven sell-off. This was forced deleveraging. Margin calls don't care what you believe, they care what you can sell. Start with silver. The volatility gauge on CME didn't just rise, it spiked to 115. For perspective, typical conditions live around the teens to the 30s. Even 40 starts turning heads. Triple digits is the market screaming, expect explosions. And here's the part people miss. Volatility at 115 while silver is around the low 70s is in many ways more alarming than volatility when silver is making highs. It means options traders are pricing bigger moves now, after the pullback, than they priced at the peak. That's not calm consolidation. That's turbulence being priced in like a storm is forming offshore. Now zoom out one step. Look at the east-west split. Western spot and futures are hovering around the same level, while Shanghai is holding a stubborn premium that refuses to die. That premium is a live, physical signal. Paper can be pushed. Physical spreads are harder to fake for long because real demand has to settle. Gold is showing its own stress pattern too. When you see metals get hit at the same time tech gets hit, your first instinct might be, the thesis is broken. That's the wrong framework. In a normal risk-off day, you often see stocks sag while gold catches a bid. But in a liquidity squeeze, correlations go to 1. Everything becomes a source of dollars. Anything liquid gets sold first. The best asset on earth doesn't matter if you need cash by 4. And that's exactly what yesterday looked like. The S&P didn't drift down. It snapped lower, wiping out around 1% in a blink, then ripped back and printed a positive close, adding more market cap back than it erased. The Nasdaq did the same thing. Hard down, hard up, like a heartbeat monitor spiking. That kind of intraday violence isn't buyers stepping in. It's forced sellers dumping into bids, then dealers and systematic flows reversing when the mechanical selling pauses. It's a market being pushed and pulled by leverage, not by fundamentals. So what triggers leverage to unwind like that? One clue. Banks reached for the Fed's repo facility, about $11 billion, split between treasuries and mortgage-backed securities. This tool doesn't get tapped in calm, orderly conditions. It gets tapped when liquidity gets tight and someone needs cash against high-quality collateral right now. The key isn't the exact number. The key is the signal. When that window lights up after being quiet, it means pressure is building under the floorboards. Now tie it together. If a large fund is long tech, long credit, long commodities, and long metals, classic long everything portfolio, then a sudden hit in tech can trigger margin requirements. And when margin calls come, the fund doesn't sell what's weak. It sells what's liquid. What sells instantly? The most liquid positions. Futures, ETFs, the stuff with tight spreads. That's why you can get gold and silver dumped even when the long-term shortage story hasn't moved an inch. It's not thesis selling. It's liquidity selling. This is why you saw the dollar act like a wrecking ball at the same time. When the market needs dollars, the dollar rises. It rises not because America suddenly became risk-free, but because global participants are scrambling for the currency used to settle the debt pyramid. Dollar up, everything else down is a classic signature of stress. Now look at the macro triangle that matters. Dollar strength, volatility rising, and yields slipping. That trio has a history. It's the market quietly rotating defensive while the headlines still act like it's just a pullback. Rising volatility means hedging demand is climbing and risk premium is expanding. Falling yields means money is running toward treasuries and the bond market is starting to price slowdown. Combine that with a rising dollar and you get tightening global liquidity. That environment squeezes leveraged players. And when leveraged players get squeezed, they sell first and explain later. Here's the psychological trap. If you stare at the metal price alone, you'll think the market voted no on the bullish thesis. But the options market is voting brace for impact. CVOL at 115 isn't a vote for lower prices. It's a vote for chaos. Direction is unknown. Violence is expected. Now add the calendar. The next few sessions carry catalysts, minutes, data prints, and the usual windows big players use for repositioning. The data itself matters, yes. But the more important reality is that scheduled events create liquidity. Liquidity is cover. When you need to move size, you do it when the market is watching a headline, not when it's quiet. That's why the most aggressive raids often happen around high-impact days. Not because the number magically changes the world, but because it gives plausible deniability while positioning shifts. So if you're watching the next 72 hours, don't just ask, what will the data say? Ask, who needs liquidity, and what do they need to do with it? Now let's get tactical without turning this into a day trading fantasy. There's a clean read on the silver chart that traders use to stop guessing. You identify the prior major low, you watch how price behaves when it returns, and you look for a failure to break, what technicians call a swing failure. When price dips below a prior low to trigger stops and then closes back above it, it often signals that the market hunted liquidity and rejected lower prices. That's not guaranteed upside, but it's a meaningful clue that sellers might be exhausting. In this case, the recent raid into a prior low and the close back above it created exactly that kind of pattern. It's one of the simplest ways to separate real breakdown from liquidity sweep. A real breakdown tends to close below key levels and stay there. A sweep tends to snap back and leave a wick because the purpose was to collect orders, not to establish new value. Right now, there's a zone that matters for near-term structure, roughly low 70s. Not a magical number, a battlefield. If price keeps closing bodies beneath that area, it suggests sellers have the wheel, and you can see the next obvious magnet below. If price holds, and you see a decisive push higher with conviction, what tape readers call displacement, then you start mapping the next levels above. This is not prediction, it's conditional logic. If this, then that. And here's where the options pricing starts to make sense. Notice day and roll decisions compress time. When open interest stays elevated into that window, positioning can get tight. Tight positioning plus high volatility equals unstable price. That's when small sparks create big moves. Now let's talk about the part that makes people uncomfortable. History. This market has a documented record of bad behavior, not internet rumors. Documented. Fines, cases, convictions. When you have a market where participants have been prosecuted for spoofing and manipulation, you should not treat sudden, violent smashes as proof that fundamentals evaporated. You treat them as tactical events that can happen precisely because paper leverage allows it. That doesn't mean every down candle is manipulation. It means the playbook exists. And when the timing lines up with low liquidity windows, stress in funding markets, and high volatility pricing, the chance of tactical moves increases. Now the big question. If this is forced selling, what happens next? Forced selling has a pattern. It's ugly, it's fast, and it feels like the end. Then it stops. Not because the world is fixed, but because the forced seller is done. Once liquidation is complete, the market can breathe again and fundamentals start reasserting. That's when you often see violent rebounds that confuse everyone who sold at the bottom. The rebound isn't optimism, it's the removal of a mechanical seller. So watch for exhaustion signals, volatility elevated but starting to plateau, price no longer making fresh lows on bad news, spreads holding, physical premium staying firm even as paper wobbles. Those are tells. And that brings us back to the East-West premium. If Shanghai stays bid while Western paper compresses, the gap becomes an invitation. Arbitrage doesn't care about your ideology. If the spread is wide enough, capital moves to capture it. That flow can force paper pricing to catch up, not out of kindness, but out of profit motive. When the spread persists, it's often because the physical market is tight. Now layer the equity chaos on top. When you see hundreds of billions vanish and reappear intraday, it means liquidity is thin at the edges. It means positioning is crowded. It means the market is sensitive to shock. In that environment, metals can get thrown around as collateral damage, even while their structural story strengthens. That is why the worst days for metals can happen right before the best days. Not always, but often enough that you should respect the pattern. Let's also address the big money bet angle without turning it into myth-making. When you see large call structures accumulate far out in time, at strikes that look absurd from today's prices, it's easy to dismiss it as lottery tickets. Sometimes it is, but institutions don't usually build massive positions for entertainment. They build them because the payoff profile is asymmetric. Limited risk, huge convexity if the tail event hits. These trades don't need to be likely to be rational. They need to be mispriced relative to the consequences of the scenario. And what scenario justifies tail hedges in metals? A world where liquidity stress metastasizes. A world where the dollar spike breaks something overseas. A world where credit spreads widen and the safe trade becomes owning real assets with no counterparty risk. That's not a guarantee. It's a map of how these pieces fit. So where does that leave you right now? It leaves you in a market that is openly admitting, through volatility pricing, that the next 30 days are unstable. It leaves you with funding market signals flashing mild stress. It leaves you with equities showing the signature of forced deleveraging. And it leaves you with a physical premium that refuses to collapse. That combination is not game over. That combination is fasten your seatbelt. Let's unpack the $600 billion vanished then came back piece, because that's the core of the title. Markets do not normally delete and restore that much value on a casual session. That kind of snap is what you see when positioning is crowded and the plumbing is sensitive. One driver is the rise of ultra-short dated options. When huge volumes of same-day or next-day contracts trade, dealers who sell those options have to hedge constantly. If price drops, they may have to sell futures to stay neutral. If price rebounds, they have to buy those futures back just as fast. That hedging loop can turn a normal dip into a waterfall, and then turn a normal bounce into a rocket. It's not mystery buyers, it's hedging math. Now add leverage on top of that. If the first drop triggers risk models, funds get told to reduce exposure. They sell. That selling pushes price further, which triggers more hedging, which triggers more risk reduction. Then, when the selling pauses, the dealer hedges flip and the same machine runs in reverse. That's why it feels unreal. It's automated. And here's why that matters for metals. When that kind of whip hits equities, the collateral value that funds post can shrink in real time. If your equity book drops hard intraday, you might get a margin call even if you think you're fine long term. The fastest way to raise collateral is to sell something liquid. Gold and silver are liquid. So metals get hit as a source of cash, not as a verdict on scarcity. This is why you can see three things at once that confuse people: physical tightness, higher volatility pricing, and a falling paper price. Those can coexist temporarily because paper is the release valve for leverage. But paper stress does not magically create new metal. It just moves claims around. If physical demand stays firm, the paper compression becomes a spring. Think about the premium like a pressure gauge. If Western paper is cheap and the premium stays wide, it says, you can print contracts, but you can't print immediate delivery. If the premium collapses, it means physical demand backed off or supply loosened. If it holds while paper sells, it means the physical market is absorbing, quietly. Now let's talk about why repo matters without turning this into a textbook lecture. Repo is short-term cash borrowing against collateral. When a facility goes quiet and then lights up again, it's telling you someone wanted cash fast. Sometimes that's innocent. Sometimes that's a warning flare. The key is to watch whether it grows. A one-off is a sneeze. A rising trend is fever. And one more piece. Sentiment. After a parabolic run, a 30 to 40% haircut feels like the end because it's emotionally violent. The crowd switches from greed to doom overnight. That flip matters because extremes in emotion often appear near turning points. Not guaranteed, but common. And here's the cliff edge. Extreme volatility plus tight positioning can create air pockets. When bids disappear, price can drop dollars in minutes. Then, when the forced orders clear, it can snap right back and print a candle that looks like a glitch. That is why support matters on body closes, not on wicks. Wicks show raids. Bodies show acceptance. Also watch time of day behavior. Real trend moves tend to hold gains through the close. Liquidation moves often happen fast, then stall, then reverse as the session ends. If you keep seeing sharp dumps that fail to hold into the close, that's not strength from sellers. That's sellers running out of fuel after they take the easy liquidity. If instead you see clean closes below the key zone and premiums finally crack, that's your signal the squeeze narrative is pausing longer than people expect. Either way, the tape will tell you. Your job is to listen, not to hope. So keep your eyes on the simple questions. Is the sell-off orderly, or is it mechanical? Is volatility peaking or accelerating? Is the premium fading or holding? Now I'm going to be blunt. If you came here for comfort, this isn't it. If you came here to argue narratives, you'll get lost. This is about mechanics. When the market is in a margin-driven phase, the only sane approach is conditional thinking and risk control. You don't marry a candle. You don't panic at a wick. You watch the levels, the funding signals, and the spreads. Here's what I'm watching into the next catalysts. First, does the repo usage expand, or was it a one-day flare? Second, does the dollar keep grinding higher, or does it stall? Third, does volatility keep pushing beyond extremes, or does it start to roll over? Fourth, does silver hold its near-term support zone on body closes, or does it slice through it like it's not there? Fifth, does the physical premium stay stubborn, or does it finally crack? If the answers line up one way, you'll see the next leg down. If they line up the other way, you can get a snapback that feels illegal because it erases days of selling and hours. That's why CVOL is where it is. The market is pricing both outcomes. And here's the cliffhanger most people won't say out loud. The more chaotic the deleveraging becomes, the more likely it is that authorities respond. Liquidity facilities get expanded. Messaging shifts. Suddenly the word temporary shows up everywhere. And when that happens, the same assets that were sold for cash become the assets people rush back into because cash starts losing its power again. That is the cycle. Tighten, break, ease, inflate. So ask yourself one question before the next session opens. Was yesterday a random tantrum, or was it the first visible crack in a bigger unwind? Now your turn. Do you think this was a true trend change, or a margin call liquidation that will reverse just as violently? And second question, are you watching paper price only, or are you tracking the physical premium as the real lie detector? If this breakdown helped you see the mechanics instead of the headlines, hit subscribe. Short, simple, effective. And stay close, because when volatility is priced at 115, the market doesn't whisper, it shouts.